In this video, I will show you everything you need to know about the latest results from FICO, Fair Isaac, the period between January 2026 and March 2026, because the company just reported earnings. The earnings were pretty good and the stock is up 11% as I'm recording this video. So, what is the plan for today? It will be a long video because the video will be complete. It will be the only video you need to watch to understand the situation. First of all, I want to analyze the earnings report. I have some comments to make, some analysis to make, so you really understand all the moving parts, what is happening. Also, I did some work on the slide deck, the investor presentation, so I will show you my analysis, so you really understand the different metrics, what is moving, what is changing right now. And also, I will show you my own Google Sheet. I did some work, some analytical works with the different numbers, different margins, and I have some comments to make. Some interesting things that I have seen no one talk about on the internet. And later, together, we will listen to the earnings call of FICO. And I will have some comments to make. I will make some pauses and add some more commentary. Because full disclosure, I'm a shareholder of FICO. It's roughly 6% of my portfolio. And now the stock is dropping like a rock. And I bought the dip, I bought the dip, I bought the dip. But it is not the first time I'm buying the dip on FICO, because I did the exact same thing 5 years ago in 2021. When the company was doubted, the stock became cheap, the stock was hated at the time, and I bought the dip in 2021. And made a fortune. Now, the stock is dropping again from very high valuation levels, and the stock is being doubted, the stock is hated. I am doing the same scenario 5 years after, and I'm happy to buy the dip. I see the same arguments today that I saw 5 years ago, and this is the exact reason why I am buying the dip actively at the moment. So yeah, it will be the only video you need to watch to understand the earnings report, because it will be complete. I mean, you will have everything, the report, the slides, the earnings call, etc. I did some external work, so I will be able to compare this performance with the entire market, the entire industry, the credit bureaus, Equifax, TransUnion, all these kind of things. And later, I think at the end of the video, I will do a valuation model, so you can kind of estimate the intrinsic value of FICO, whether you whether you have to buy it even at these levels, after the stock price is up 11%, or is this a hold? Is this short term? What is happening? Okay? Should we start? We can start. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. Because of FICO also. Because I bought the dip at a very appealing valuation, and I had a very nice gain on FICO. And I'm doing it again. Just so everybody understands, let me do a quick 2-minute recap of what FICO is. It will be extremely simple. First of all, the company has two segments, the score segment and the software segment. Let me first tell you, we don't care about the software segment. We absolutely do not care. This is not the reason I bought FICO at all. I could not care less about the software part. It will get disrupted by AI, maybe yes, maybe no. It is not growing, it is not that profitable, we don't care. What is important is the most important segment, the scores. The scores, B2C, B2B, they create the FICO score in the US. So this is the ability for banks to judge people, whether they will have a nice interest rate or not, whether they will repay their loan or not. And this is a form of language, right? For decades, FICO has been in a monopolistic position, and it is maybe changing now. But many times, people came and started to disrupt the industry. They did not work. FICO, for the moment, stays almost a monopoly. And because they are almost monopoly, they are printing cash. And in 2018, they unlocked a new pricing power. They could raise their prices per scores. So you will see something very strange. If you go to the revenue line, you will see that the revenue is up and to the right and accelerating since 2018. The net income is up and to the right and accelerating since 2018. The free cash flow is up and to the right and accelerating since 2018. And that's it. That's the end. The company is doing a little bit of leverage buybacks. They are having a little bit of debt, not so much, right? But a little bit of debt, and they repurchase their shares massively. No dividends, no acquisitions, no stupid things, just no major capex, just buybacks, buybacks, buybacks. So extremely simple business model, extremely simple capital allocation framework. Now the stock is down because at the time the PE ratio was 90, so it was really expensive. And if you have a problem at a PE ratio of 90, you get crushed. So some political people came and said it's too much price gouging. It's a monopoly. It can no longer stay a monopoly. Let's introduce a duopoly. And it is kind of working, right? You have additional pressures and people freak out, people panic. And if you have problems at an expensive valuation, like a PE ratio of 90, you get demolished. And now the valuation has dropped significantly. The stock price has dropped significantly. We have a forward PE ratio of roughly 25. So from 90 to 25. That's why the stock is down. Okay, so let's start with the report. Let me put my face in small so you see better. I hope that's zoomed in. Some colors here. Green is good, yellow is neutral, and red is bad. Okay, that's quite simple. First of all, the company reported revenues that are up 39% year on year. This is the fastest they have grown for the past decade because for this quarter, they implemented a doubling of their prices. The price per score is no longer $5 per score, but it's $10 per score. So of course, your revenue will be shockingly high, okay? And of course, the management will sound bullish. They had the ability to raise their prices and customers continue to pay. So this is lovely. We continue to deliver strong revenue and earnings growth, said Will Lansing, CEO. We are pleased to announce that we are raising our full year guidance. First commentary. I was expecting them to raise, what is that? To raise guidance in this quarter. Because as a proper shareholder, I'm doing the work on the other credit bureaus, the potential competitors, Equifax, TransUnion, and during Equifax earnings call, the latest one, right, from 1 week ago, 2 weeks ago, they explained volume was strong in January, February. More people applied for new mortgage origination, right, for new loans. So I cross-read this into FICO. Let me show you what I mean. In this video, I will go step by step. So I will take my time because I want my audience to understand. Let's start with this one. Equifax. So a credit bureaus, FICO at the moment is trying to cut the credit bureaus and no longer work with them, or maybe less. So you have a little bit of a fight between these people. And in the latest earnings report, April 21st of Equifax, they said the volume was pretty strong. The volume, Equifax delivered strong first quarter, primarily driven by significant outperformance. US mortgage revenue up 38% reported and 24% excluding FICO. So the volume coming from US mortgage is pretty good, 24%. Also in the Equifax call, they said the volume, so more people, more pools of credit scores, were very strong in January, very strong in February, very bad for March, and recovering for April. All in all, pretty good, going up 20%. This is the first information we could have had before the earnings report of FICO. Second of all, we have this from TransUnion. TransUnion, boom, from the housing guy. Congratulations for spotting this. Interesting to see what TransUnion says this morning. TransUnion reported earnings a few hours before FICO. FICO reported earnings when the market closed. TransUnion when the market opened, like a few hours before. So we could have had this information before FICO went up 11%. So TransUnion says this market already did out. The mortgage revenue is up 20%. So both bureaus are reporting, 2 out of 3 bureaus are reported strong volume for mortgage up 20%. So for FICO, we could have cross-read this saying, market seems fine. So if the volume is fine, and at the same time you are doubling your prices, of course you will print cash. How many people did this analysis? So few, right? So few. Yeah, I mean, you had the information publicly. And guess what? I talked about this. In a live session that I published a few days ago. I'm doing live sessions with my subscribers and members of the YouTube channel where I share kind of good information, private information, and we did the deep dive of FICO, seeing the announcement, the volume from credit bureaus, January good, February good, and we said it's quite likely FICO beats and raises the guidance. I mean, the information was there before. The market is healthy, and they are increasing their prices, so we announce good things. If you want to be part of the next member-only live session, you can join this channel and be a member. It's only $5 per month, like the price of a coffee, and you will have access to all the recordings, all the replays, and you can ask your question for next time. Okay, you know what to do if you want complete information here before the markets realize it. Second point, talking about volume, I have something else to show you. I want to show you this, the mortgage market in terms of volume, inquiries. It's not that great, but it's a good information to know the volume versus pricing. And I'm aware this video is getting complex at the moment. Stay with me, go back in time a few minutes ago if you want me to repeat. But yeah, this is what is happening for FICO. Two engines can drive revenue up for FICO. Either you increase your prices, you double your prices, or you have more volume, more people asking for credit pools, for score pools. So pricing, volume, pricing, volume. Pricing, we know they doubled their prices. And volume, I'm showing you the data that we had before the market. So from Equifax slide deck, this is the market of volume for mortgage market. You can see for the past decade, you can see pretty stable 2015, 2016, 17, 18, 19. In 2020, interest rates were at zero. A lot of people bought their houses almost for free. They had a huge market boom in 2020, 2021. Interest rates were at zero, so of course it was free to borrow money. Even Warren Buffett was telling people, I mean, you could borrow money for free. So yeah, quite shocking industry, and a lot of people benefited from this. And in 2022, big drawdown. 2023, big drawdown, and the market it started to recover slowly but surely. What if the volume goes up again? Back to where we were at 2015, 2016, 2017. The volume part can grow, can continue to grow right now. So it was for February 2026. I can show you more granularity. Here, this is a slide deck that is a little bit older, from June 2025, if my memory is correct. And this is the market overall. Mortgage, hard credit inquiries down a lot. So from June 2025, it was not looking great. What I'm telling you is, what if we go back to the average with a new pricing structure? Now that FICO has increased the prices meaningfully, what if for 2027, the volume goes up a lot by 20%? You keep your high prices and boom, it will get lifted by volume. FICO can continue to grow at a very healthy rate even next year. It will be driven by volume right now. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. So that's for the volume explanation. What about the pricing explanation? FICO announced a few months ago that they were going to double their prices from 5 to 10. Okay. Also with the new competitor, FICO Score, but now Vantage Score, at $1, FICO introduced a new pricing model of $1 per score, but $65 success fee. Don't worry, I will explain in more details later, but I'm just doing an introduction here of the concept, right? So a new monetization with a new price per score, either it's $10 for a score, or it's $1, but if you have success in your score, in the mortgage, in the MBS, you get $65 in success fee. So different margins, different pricing structure that are quite bullish for FICO. We don't know if this will be good, great, mediocre, but they are starting new things. So based on this information, more prices, new structure for pricing, and more volume. You cross-read this with Equifax saying the volume was strong in January, February, mortgage is growing 20% per year without FICO. You cross-read this with TransUnion saying, yeah, the market is fine and we grow 20% because of more revenue. You could have expected a beat and raise from FICO. And the raise in guidance was supposed to be huge. FICO is known for increasing their guidance. I've been tracking the business since 2017, and they are pretty conservative on the guidance. In Q4 2025, if you go back in history, you can say they were extremely conservative. You can do a Control F. Where am I? Conservative. So in November 2025, they say, this was from the earnings call. We are pretty conservative, by the way, we guide generally, but we are probably more conservative this year, so now, because there is a lot of uncertainties in the macro environment. We are being very conservative, again, conservative. We are being really conservative. We are always conservative, but this year, probably more than other years, we are extra conservative. Okay? In Q1 2026, so January 2026, again, we said we are pretty conservative. And at the time, analysts from Wall Street were asking, what about your guidance? Are you still being conservative in your guidance? Given the new competitive pressures, are you going to raise your guidance? And management said, no, let's wait a little bit. Maybe not in January, but in April, maybe we will raise the guidance, but we'll let you know. We don't know. We don't want to raise guidance and then decrease the guidance and then increase it. So just take our time. Don't be in a hurry. And 3 times in a row, in January, in the call, I listened to the call. 3 times people asked, can you raise your guidance? When will you ask your guidance? The CEO said, no, don't worry about it. We are being conservative. We'll let you know in the future. And then another analyst, can you raise your guidance? No, so a lot of people were asking about this new guidance. We are being conservative, but by how much? And now, the new information we had, Equifax, more volume, etc., it was not 50-50 that they were going to raise their guidance today for this earnings report. It was quite likely they raised their guidance. And a few days ago, I released a video about the earnings reports I was following, saying, okay, what do I expect from FICO? You can watch this video, it's public, this one. And here is what I had to say about FICO. I mean, all the signs were there. But I think what is more likely is a beat and raise, actually, from FICO. I think they will raise their guidance. I'm not certain, right? But in terms of odds, it's not 50-50. They are more likely to raise guidance than lower the guidance. I think the guidance they can increase. Actually, the guidance they have right now is a growth rate of 26% for earnings per share. I think the guidance can go from 26% to 36%. Boom. You get 10 points more. Yeah. So let's see how the new guidance is. Let's see what it looks like. Okay. The guidance is exactly this. The earnings per share guidance went from 26% to 34%. Boom. 10 points more. 8 points. 8 points more to be exact. And it was not priced in. People did not expect this scenario. And now people are in shock. I'm seeing what is happening on the internet, on Twitter, on YouTube. People are in shock how good and how shocking this quarter was. It's shocking. They are shocked because they didn't do the work. But I was there buying the dip. Okay, let me continue with the report. Okay, so this is the explanation what we could have cross-read between the different companies. I hope it was clear for you guys. If it was clear, leave a like. And now let's see into more details the numbers, right? So, first of all, Scores revenues, which include the company's business-to-business B2B scoring solutions and business-to-consumer B2C solutions, were $500 million in the second quarter compared to $300 million, an increase of 60%. Overall, for the Score revenue. Yes, you double your prices, of course it will be shocking. And the B2B revenue, so mortgage, up 72%. Primarily attributable, and this is the first question I have. The first yellow flag I found. Primarily attributable to higher mortgage origination Scores unit price, because they doubled their prices, and an increase in volume of mortgage originations. Yes, 20% here and there we could have cross-read. My question is, by how much? What is the mix between price and volume? Out of this growth rate of 60%, how many points are due of the doubling in prices? How many points because of volume? I want the management to answer this question. Are you growing just because you are doubling your prices? Or are you doubling because the entire industry is lifting the level of the sea level? That is raising all boats, lifting all boats. So if that's only price, maybe that's not sustainable. Because, you have to double your prices again to grow revenue again. If that's volume, and it's a large part, that's good because the market is healthy and maybe interest rates will go down in the future. So you have more people, more applications for new loans, new homes, etc., home buyers, etc. So I want to see the mix here. Is that 50-50 or 75-25? Pretty interesting. So let's see if they answer this question. And then for the B2C, increase revenue 5%. Yeah, that's a small part of their credit market, score market. I could not care less about this market. It is not the reason why I'm buying FICO, but I'm putting in red because the B2C revenue is only growing by 5%. And then software revenue. I don't care about software. It's up 7%. I don't care. Frankly, I don't care. And I'm not buying FICO for that. I can show you the split between Scores and software to show you how irrelevant this is. I will use Fiscal AI. I can use revenue comment size. What I want to show you is the blue chart. The blue chart right now, that's how much of the revenues are linked to Scores. You can see 68-69%. So roughly 70%. 70% of the revenue is linked to Scores. The remaining part, 30% software, I don't care. This is not what is important for FICO. In the past, Scores were representing 40% of the revenue, but because they are printing cash, it goes up to 70%. And I think it will go higher than this, to 80%. So I don't think the software part is relevant at all. And I will not focus on this on today's video. Okay, let me scroll down. So, they raised their guidance. Let's see by how much. I expected a raise in guidance. This is great. Revenue was expected to grow 18% for fiscal year 2026. The updated guidance is a growth rate of 23%. The net income went from 22% growth rate, 27%. The earnings per share, what is important, the most important part, from 26% to 34%, almost 10 points more. The non-GAAP net income, we don't care, from 24 to 29, and non-GAAP EPS, 28 to 35. So, if we adjust for the new GAAP EPS, earnings per share with the new guidance, if the earnings per share for 2026 is $35.6 here. Then the real PE ratio for FICO for 2026, when it was trading at $1,000, like yesterday, it was $1,000 divided by 35.6, that's 28. What you see on several websites, the valuations you see are wrong. The PE ratio you see here, 32, wrong. You have to update for this. The valuations are up and down, even for the trailing valuation, the forward valuation, it's a little bit of a mess. People forecast things for the future. You have many estimates going up and down. People don't really know the valuation. The valuation is lower than you think because the earnings are higher than you think. So yesterday, now I'm recording this video before markets are open. European markets just opened. We are at $1,000. With the new guidance, you had a PE ratio of 28. For a business that can grow double digit at a very, for a very sustainable time, I would say, with very nice margins, maybe they will lose their monopoly. It will be a duopoly. What is the PE ratio for a duopoly? Growing at double digits and printing cash with nice margins. Look at Visa and MasterCard. They are not trading at a cheap valuation. They are very good businesses, Visa, MasterCard, and they are trading at a premium valuation because these are premium businesses. And now, yesterday, you could have bought FICO at a PE ratio of 28. So, a okay valuation, not cheap, right? But okay valuation for something that grows a lot, that has a lot of market share, growing nicely with nice margins. It is not expensive anymore. I don't think FICO is expensive at the moment. Let me continue. On this earnings report, I have other things to show you and then we'll move on to the slide. The investor presentation will give you a lot of information. Don't worry, I have already analyzed it. Okay, they talk about their balance sheet. They raised more debt from $2.6 billion to $3.6 billion. I don't think that's important. Why? Because I can go down and show you the cash they generate. For 6 months, it was this. So in 6 months, they generated an operating cash flow of $400 million. So that's for 6 months. For the full year, you have to double this to have 12 months. So that's $800 million in free cash flow. If you that's roughly $1 billion, right? Because it will grow next year and next year. Okay, so let's say they generate $1 billion in operating cash flows. In how many years can you repay your debt? 3 years? 4 years? In less than 4 years, you can repay your long-term debt, which I believe is quite reasonable. I don't think FICO has a debt problem. They recently raised more debt, $1 billion at a 6% yield. I think that's okay because they are growing so fast. Okay. They also share their income statement, but I will have a Google Sheet later in this video, so you will understand much better than only looking at this. And for the cash flows, last year in 2025, they had $300 million in operating cash flows, and they did buy back some stocks for $400 million. Okay, so more than 100%. For this year, 2026, the cash flows went up $400 million, but they almost doubled their level of buybacks, almost $800 million. They are very aggressive in doing buybacks. As the stock price is dropping and the story is accelerating, the management is confident to do a lot of buybacks. And this is it for my earnings report. Okay, let me show you some charts now. Let me show you the cash flows over time, the capex over time, the buybacks over time. The company doesn't pay a dividend. The company doesn't do M&A, no acquisitions, no mergers. They even had a diversity tier in 2021. Maybe I can show you here. Should be here. Proceeds. They sold a division. Don't worry, I will explain. Okay, so this is, let me show you step by step. In blue, this is your cash from operating activities. Okay? On the last 12 months basis, this is what you have. This is what I told you before. It's up and to the right and accelerating since 2018. In orange, you have your capex. Do you see it? No, you don't see it because the company is so asset light. They don't need capex. FICO is an algorithm and that's it. Almost no capex. You have some software capex. I'm very well aware of it, but this is it. People don't care. This is it, your software capex. Do you see the software capex here? Well, no, it's too small. Do you see a little bit of red here, but almost zero capex for this company. Very asset light. Then let me show you the buybacks. First, let me show you the M&A activity. Boom, in green, as you can see here. This is the M&A activity. When this line is down, it means you pay for an acquisition. But this line is not down. You see a green chart, a green candle that is positive in June 2021. What is that? Well, I was a shareholder in the past. They sold one of their division. They cut one of their arms, one of their legs, to raise cash and do more buybacks. Because this part was not very profitable. So FICO understands capital allocation at a very deep level. They don't want to burn cash with capex. They don't want to burn cash with stupid acquisitions. Actually, they want to raise cash by raising prices, by cutting the bureaus, by improving their margins all the way. And also they want to raise cash to cut a division that is not so profitable. So they know exactly what they want. They want to be a cash machine. And what are you doing with your cash? And now be prepared. Boom. In purple, this is the amount of buybacks you are doing. In 2021, the stock was dropping like a rock. They did a huge buyback program, the biggest buyback program ever. And then the stock recovered, the valuation became high, they stopped the buybacks, and now the valuation is dropping and dropping and dropping and dropping, and the stock is going down and down and down, and they just did their biggest buyback ever. And they announced it today. So I'm seeing the exact same scenario that I saw 5 years ago. The management is doing the exact same things that they did 5 years ago. This is it. So if you want to smooth things out, this is what you have. Boom. The stock drops in 2018, you do massive buybacks. Stock recovers, you stop the buybacks. The stock drops in 2021, you do a massive buyback program. The stock recovers, you stop. The stock drops in 2025, 2026, you do a massive buyback program. Okay? So that was it for the capital allocation part. The company will continue to do this. No stupidity. Now, let's talk about the slides. Slide deck. Okay, perfect. Let me put this. I had some comments for you. I have to say they changed the reporting of the slides from 2 quarters ago. So last quarter, they changed the format of the slides. And we had new information, by the way. In the past, we didn't have smiling people. In the past, we didn't have hands. It was quite boring and I liked it the old way. But yeah, they maybe hired a new guy for investor relations. They changed the format and they added new slides along the way. So let's see. So first of all, they start with pride. Strong top and bottom line growth. Revenue up 60% for the scores, driven by B2B mortgage revenue. Net income is up 60%. Earnings per share up 69%. It's a spectacular performance. And let's see if they have a slide about price versus volume. This is a question I still have. Let's see. Let's see if they talk about the mix. How much of the increase is due of the price gouging and how much of the increase is due to more volume. And free cash flow, you have almost $900 million trailing free cash flow plus 28% year on year. Yeah, we already showed this. They are printing cash. And yeah, right now, the operating cash flows, the free cash flow formula is very simple. You have the blue minus the red here. So almost the same. The free cash flow is extremely, extremely high and growing for this business. Now they have $900 million of free cash flow. So they can repay their debt in 4 years. $3 billion is nothing for them. And they are growing a lot. Okay, so free cash flow is really high, plus 28%. Provides capacity for both reinvestment, where they are lying a little bit here. Reinvestment with capex? No, you don't have capex. And returning capital to shareholders through share repurchases. They are doing it. Talking about buybacks, they have a clear segment about buybacks. $600 million shares repurchases expense at an average price of 1,200 price per share. And later in this video, I will show you exactly at what price they did buybacks. At 1,500, 1,300, 1,100, because they share it. And I've seen one person on Twitter talking about this. So I will talk about this later. Did they increase their buybacks as the stock went down? Or was it like a monthly price buyback? Yeah, you buy back a little bit every quarter on a reputable basis. You will see. It's the single largest quarterly repurchase in dollars in FICO history. Yes, I showed you that before. Let me scroll down. First of all, they are very proud. It's about ego at this point. Scores. At the time, it was growing 25% per year, 35% per year, 20% per year, 20%, and now boom, 60% per year. It's the single one reason why I bought the dip on FICO. I don't care about software. The software is growing 7%. You will have some slides about the software. I don't care about software. Frankly, it could grow, decrease, 2%, minus 2%. I absolutely don't care about the software segment. And then here is what is red. Here is what is bad. FICO scores in the US industry a standard measure of consumer credit risk for over 35 years. FICO has been a monopoly for 35 years. On a B2B segment, business to business, the FICO scores are used by 90% of top US lenders. My question is, for how long? And this is the biggest risk for FICO. Now that the regulatory regime is changing, now that you have a duopoly, FICO scores and VantageScore, for how long? Maybe they will get more market share. Maybe the new competitor, the VantageScore, that is being helped by the government, maybe they will steal some market share. By how much? This is an information we want today. Maybe they will share it on the slide deck. Maybe during the earnings call. If I was an analyst from Wall Street, I would definitely ask this question. What is the market share of FICO exactly? And what is the market share of VantageScore exactly? From what I've read, I think it's less than 10%. I think it's less than 5%. The VantageScore is tiny. 5, 4%, 5%. And people make a huge deal because what will be the market share in the future, right? I understand this. But I think right now it's tiny, less than 5%, I would say, the market share for VantageScore. FICO is still a clear leader in its category. And FICO is talking about its competitive advantage. Why would you change from FICO to VantageScore when we have been the industry standard across all lending verticals and for securitization? It's the most predictive scoring model in the US. It's the only credit score with known predictable performance through a full economic cycle. This is the moat and why FICO will not be disrupted by VantageScore. Because FICO has been used for 35 years, the FICO scores. In 35 years, you have seen many cycles, right? Dot-com bubble, 2008, COVID, scenarios with low inflation, low interest rates, but also high inflation, high interest rates, recessions, economic booms, lockdown. You have a lot of data, you have a lot of information that VantageScore doesn't have. VantageScore was created in 2006, but for their VantageScore part, they don't take 35 years of data, they only take 2 years of data. So between 2023 and 2025. We don't even cover one economic cycle. If you want to use the new guy, the new competitor, VantageScore, you have only 2 years of data. So of course it's a lower quality score because you have lower quality data. You only have 2 years. When FICO has decades and economic cycles. If you have more data, you are more resilient. You are more sure of what you do. You decrease your level of bankrupt people that don't pay off their loan because you have the data. It's a language for decades. And I think it will be very hard to disrupt a language like FICO. Let me scroll down. Scores business update. This is a new pricing model to compete with the $1 pool for VantageScore. Okay, so I told you a few minutes ago that VantageScore wanted to compete with FICO Score. FICO Score is too expensive, that's $10, people complain, it's too expensive, it is disrupting the housing market. I could not disagree more with this. But anyway, VantageScore is coming and saying, you know what? Our score is free. It's only $1, almost free. So FICO counter-attacked. And they said, guess what? We are also delivering a free score. So now you have the choice. You have pricing optionality, as they say. Either you pay $5 per score, but 33 funding fee, or you have $10 per score, but our score is better, so maybe deserves a premium. We have decades of data. Or you have something else, something new now, that is only new for this slide. We didn't have this before. We have a new pricing model. Our FICO score is 99 cents per score, so $1. But if you have success, you have a success fee of $65. So the browsing score to pull a score that's $1. For VantageScore, if you succeed and you make a package or if the loan is successful, that's it. You don't pay, you pay $0. But for FICO, you pay $65. Do you think it will improve the business model of FICO or deteriorate it? Do you think it will improve the margins of FICO or deteriorate them? Do you think it will help FICO fight with market share, or do you think they are passive and complacent? My opinion is clear. I think FICO was prepared to fight. They saw the new regulation. They saw VantageScore coming for them at $1 per score. They saw the attack. And when the VantageScore was publicly announced, it was official that, okay, it's no longer a monopoly, it's a duopoly right now, from a few days ago. A few hours later, FICO released a new blog explaining, okay, guess what? We are also doing $1. The same day, they were ready to counter-attack day one. In my opinion, they want to destroy competition from day one. They were ready. They've been talking about this new pricing structure for more than 1 year, but we don't have the prices, like we didn't have the numbers, 165, we didn't have this before. So the same day it was released, VantageScore is officially public, the same day FICO is doing, we are also doing it for free. But you also have to pay $65. So for the browsing experience, that's the same, but only if you are being successful, you pay. But successful fees are much more hidden. People are happy to pay a success fee. And I can have this analogy for you, so you understand the new pricing structure. There is a company called Hemnet. It's the Sweden dominant real estate listing platform, like Zillow, but with a total monopoly in Sweden. Everybody, you want to sell your home, you list on this website, and then the website gets a fee. For years, Hemnet from Sweden, it charged sellers a flat fee upfront to list their home. And people complained. I mean, if I put my home for sale, I have to pay a fee, But if I don't sell my home, you still get a fee. I mean, it's as if you list on eBay and you had to pay a fee just to list on eBay. And they continue to increase prices and prices and prices. Like exactly like FICO is doing, right? You raise prices and prices and prices. A few years ago, the FICO score was a few cents, 60 cents, and then $1, $2, $3, $5, and now $10. And for Hemnet, people complain, you are raising your prices too much. And then, when people complain, it switched to a sell first, pay later model. You list for free, but you only pay a commission when your home actually sells. This made the fee invisible and politically painless, while Hemnet quietly made far more money per transaction. The stock tripled. That's the model your student comparing to FICO. Yep, we already talked about this inside my coaching program, and this is a great analogy, I think, because it's less painful to pay a fee if you are successful. The fees when you have a mortgage application, that's in the thousands of dollars. So paying $65, that's peanuts. I mean, you pay everybody thousands of dollars. If you are successful, you will pay. That's it. So FICO is replacing its $10 per score pool, which everyone was screaming about, with a $1 pool fee plus a $65 funding fee paid only when the mortgage actually closes. Same idea as Hemnet. Make the visible number small, attach the real revenue to a success event. So now a few things can happen. That's the bull case, bear case. While it could work, the political problem disappears overnight. Nobody runs a campaign against $1. Meanwhile, the economics are actually better because the browsing experience becomes painless. And I would say you will have a success out of 1 in 8 credit pools, which means this new pricing model can bring even better margins for FICO. If you can cross-read with Equifax, they said 1 out of 7, 1 out of 8, 1 out of 9 is a success. If FICO is smart, they do their analysis correctly, mathematical stuff correctly, normally this would bring more margins to FICO in the future. This new pricing model. So you are telling me that you have a new competitor in town, FICO is counter-attacking them day one, and there is a scenario where it's an even higher margin business. Yeah, it's quite important. So this new pricing optionality may be the new model for FICO. Maybe over the next few years, they will stop on this flat fee and convert everything into a success fee. It starts with a $65 funding fee. It can increase, $75, $85. People don't care. They are successful, they are happy, they are already paying thousands of dollars. They don't care to pay $65. It can be $100. For a tri-merge credit pool like this, tri-merge report, you have $200. So numbers are irrelevant here. What I want to say is it can go higher. The pricing power of FICO is not done. So this is bullish for the long term. I hope that's clear. Now they are comparing their FICO score with the Vantage score, the ease of reseller adoption, compared to credit bureau process. If you use FICO, you have the same model calculator as before that you have been using for decades. Same data input and output, very simple. Same data format used by DU and LP, the GSE underwriting systems. That's the bull thesis. People are lazy and will not switch to another language. It will be too much of a hustle to just change your language. I mean, bankers, banks, all the mortgage origination, all the lenders have been using FICO for decades. They are lazy and now it's $1. You only pay if you are successful, so you don't care. The bull thesis is nothing ever happens. People will become lazy. This is why they are putting this. And then next slide, FICO Score 10T is the logical choice for market participants. It's the most predictive and inclusive score. If you use FICO 10T and you pay more, you have 18% more defaulters identified. So it's better, it's safer to use FICO. Also, you have 5% increase in approval volume. So yes, you have a closing fee. Yes, you have a success fee. Yes, it's more expensive, but it's better. So is this warranted? Maybe. People have the choice. People are lazy. They want safety. Bankers, lenders, they don't want to lose their job. What if you give a loan to some guy? What if you create an MBS package and you get defaulted? You will look stupid. It will cost you your reputation and your job. So you have this choice, or you can go to the safer route using FICO. Everybody knows FICO. You know FICO is safe. You have less risk. But that's a little bit of a premium. So you pay up for quality, as always in life. Also, they share this trended rental, telecommunication, utility data, more consumer insights. I don't think that's true. I think they are lying here. Not true. The Vantage Core is also using the utility bills, electricity bills, telephone. Some scores are using where you live in the neighborhood. Some other scores in the time we're using like what kind of job you have. Something for your parents using AI. Anyway, I think this is fake news here. They are not saying the truth here. They say FICO is better because we use your utility bills. No, Vantage Core is also using utility data. The third point is valid. It's truthful. Backward compatible with prior FICO scores. Ease of transition for lenders. Laziness. Okay, nothing here on this slide. Nothing important. Let me speed up. This is not important. They talk about their software. Let me scroll. I don't care about software. And then they explain the different growth rates for B2B with massive price increases. B2B growth mainly driven by higher mortgage origination scores unit price and an increase in volume. By how much? How much is linked to volume? Origination revenue growth year on year. For the mortgage part, it's 127%. So, what did I say a few minutes ago? Equifax Credit Bureau was saying we are growing with more volume 20% per year. TransUnion, another company that we've seen before, is saying we are growing roughly 20%. And FICO is growing 120%. So my question that remains is how much of the 127% is because you doubled your prices? What is the mix, price versus volume? So, well, they doubled their prices from $5 to $10. They have a new pricing model. It's $1, but $65 for success fee. So quite blurry. So maybe my guess would be 80% of this is due to price increases, 20% more volume. So what's 80% of 120? That's a lot. If we didn't have this price increase, you would have 20%. It would have been a very good quarter, but not so great. But because you double your prices, of course, it looks shocking. They have a revenue segment mix. The B2B segment, in the past, it was going 30%, 40%, 30%, 30%, and now 72%. They say price increases take effect starting in Q2, so now, and you see a big jump. They still don't answer my question. How much is the mix? Price, they don't want to answer it. Mortgage is now 72% of total B2B revenue, as you can see here. That's the main growth driver. So the B2B segment, so let me start top to bottom. What moves FICO between scores and software? That's scores. Boom. Between scores, you have B2B, B2C. What moves the score segment is B2B. So second step, scores, B2B. Inside B2B, what moves the segment? Either mortgage here or rest of B2B. No, mortgage. So boom, 3 steps from top to bottom. What moves FICO? What is important for FICO? And this concentration has gotten more important. today? What will make or break the thesis of FICO? That's not software, that's not B2C, that's not the rest of B2B. That's only this line in green, mortgage. So, it's very important to see the disruption risk. Not because of AI, but because of a new competitor in town. This is what is extremely important for FICO. The only one thing to monitor for FICO. So during the earnings call, we want to check this. What are the new competitive moves, the new competitive advantages you have in this market? What can you see? What can you say about VantageScore? Who are your customers? I mean, we already know, but what are your customers saying? Are they trying VantageScore or still using FICO 10T? Are they happy with the price increases? Are they not caring at all? Maybe they don't care because it's only a closing fee, success fee of $65. All these questions. What is this trend moving? I mean, what will be the future of the mortgage market? This is the number one thing that will move FICO stock. Let me scroll down. I don't care. This is book. I don't care. Software. No. Let me scroll. Of course, if you double your prices, your operating margins will go higher. Of course, if you double your prices, your non-GAAP operating margins will go higher. So you have operating margins of 55%, and you are using all your cash to do buybacks. Okay? And you have a consistent leverage ratio range. That's reasonable. As we've seen before, the net debt is inferior to 4 times free cash flow. They can repay their debt in 4 years of free cash flow, even lower than 4 years. Like you have $4 billion of debt, $1 billion of free cash flow. That's a healthy range, in my opinion. We are on the upper side, but still reasonable. And they are raising their guidance. Now earnings per share are not growing at 25% per year, but 35% per year. 10 points more, and I am done with the slides. Now let's talk about the numbers. I want to share my Google Sheet. I want to share my Google Sheet. I will zoom in and show you step by step what is happening for all the lines, all the revenue expansion, margin expansion, the expenses, and you can see at the right, I have some screenshots to show you. So again, you will have my commentaries. I told you this is the only video you need to watch to understand the latest earnings report from FICO. If you like this format, leave a like, add a comment saying I liked the video, subscribe, become a member to this channel to have access to exclusive live sessions and Q&A sessions. Ask your questions to me directly, okay? And if you want some exclusive content, you can become a prestige member. You will have videos in advance. You will have live sessions with priority with you. I will comment, I will answer to your comments in priority, and you will have exclusive videos. So yeah, this is what you can do. But I hope this video will help as many people as possible. Because as the stock price is dropping, all I'm seeing on the internet is panic. Okay, so I have created this Google Sheet between March 2025, so between January and March, and same thing for March 2026. Let's talk about software. On-premise and SaaS software revenue, that's the line number 4, is growing 8% per year. The professional services, minus 2% growth rate. And then what moves the needle is the scores revenue up 59%, 60%. So all in all, the revenue of FICO is growing at 38%, 39% year on year, just because of scores. And as I told you before, the score segment is getting more and more importance. It is now 70% of the total revenue. So FICO will be more and more linked and glued to this growth rate of scores. And if scores can continue to grow at double digits, the revenue will grow at double digits. At the same time, the cost of revenues are only up 4%. Only up 4%. So you can grow your revenue by a lot, and your costs are not growing that much. I have a few comments now. For scores, we have scores now account to 65% of the revenue. Let me show you the proof of what I say. This is the chart over time, total scores revenue. In the past, it was 40%, 50%, 60%. Now 70% of the revenue is linked to scores. Second point, second chart, that's the biggest growth rate for scores in the decade. Let me show you this chart. And yeah, you can see since 2016, it was growing 20% per year, 15, 0, 20, and boom, 38% growth rate for the total revenue because scores went up so much. And with this kind of growth, the expenses are only up 4%. It's a beautiful asset-light business model. Gross profits are up 40%. And of course, the gross margins are up. Gross margins went from 82% to 86%. You don't have a lot of businesses with this kind of profitability. At the same time, the company has more cost. R&D plus 20% more cost. SG&A 20% more cost. So the total operating expenses are up 20%. You could have expected less, to be honest. Frankly, you could have played with the numbers to deliver less than 20% growth rate in expenses. But that's okay. You know why? Because operating income is up 60%. They have beautiful operating leverage. And the operating margins went from 49% to 58%. They got 10 points more EBIT margins. And I can show you this chart that will shock you. This is the level of profitability they have, the operating margins over time. You can see 10 years ago when they didn't have pricing power, they had an operating margin like a software business, roughly 20%. And then in June 2021, they sold one of their divisions that was not really profitable. So you have a big spike here in 2021. Of course, they sold the division. It created some cash inflow, but you have to adjust for this and say it never happened because it's not about the core operations of the business. It's a one-off event, one-time event. So over time, margins have beautifully grown 20%, 30%, 40%, 45%, 50%, and now 58% operating margins. Can you name 10 businesses in the world with this kind of profitability? You have very few companies in the world with such high operating margins. And I think it will go higher than this because of the new pricing power and the new optionality, like $1.65. I think it will go higher than 60%. Next year, it can go to 65%. I will not be shocked at all. I am expecting higher margins over time. In earnings calls, the management team sounded very bullish for margin expansion in the future. The management team is clearly telling you margins will go up. I have checked all the earnings reports since 2017. I have checked all the times they were conservative on the guidance. Almost every year, they were conservative on the guidance. They're always beat and raise. Always. Now they did it again, and people act surprised. I have checked the truthfulness, the honesty of the management team over time. Most of the time, a large majority of the time, they are honest. They are competent. When they say something is true. When they say something, they do it. And now they're telling you they will continue to increase margins over time. And they say, we are fine when it comes to competition. Okay? Well, let's see during the earnings call if they add some commentaries on VantageScore, but they never sounded alarmed by the new competitive pressures. And if history is a guide, if they tell the truth, you are in front of a compounder, a stock that is hated right now, at a reasonable valuation, with a nice growth, a near monopoly, and improving margins. This is why I bought the dip. Let me continue. Operating margins went up 10 points. You have all the income net, that's the cost of debt, that went up 40%. The company has to pay interest expenses. Of course, you have debt, you have to pay interest on the debt. So the cost of debt is going up by 40%, which was to be expected. So overall, the income before taxes is up 67%. The pre-tax margins went from 42% to 51%. Then you have to pay your taxes. Taxes are up 80%. By the way, the tax rate went from 23% to 25%. So you have slightly higher taxes. If you had the same level of taxes, the net income would have been greater. So it's a small, tiny headwind I see for this quarter. They paid more taxes. So all in all, you have a net income that grows 62%. And because you do buybacks, like 4% buybacks, this is their biggest buyback ever. Ever. When the stock became cheap, when the stock dropped like a rock, the earnings per share, EPS, have grown at 69%. If you didn't have a tax increase and the tax rate was 23%, I mean, if I change $91 million to 85, no, I have to put it even lower, 83. Okay, let's say it's roughly the same. If you had the same tax rate, the net income would have grown at 67%, and the earnings per share would have grown at 74%. So the core operations of FICO are not growing at 69%, but 74%. Okay, so it's a small headwind that didn't help, but still they are growing 69% their earnings per share. They did their biggest buyback ever when the stock dropped like a rock and became cheap. And they were very aggressive when the stock price dropped below 1,200. This is what I said before on this video, saying, can you check the level of aggressiveness? So you have the granularity month by month, the level of buyback they did. Between January 2026 and end of January, so during January 2026, they repurchased 50,000 shares. That's thousands or millions, I don't care. That's 50. For February, the stock continued to drop. For January, the stock price average was $1,500. For February, the stock price dropped. They repurchased more shares, 76. The stock price was $1,300. And for March, the stock dropped again at $1,200. They did 358,000 of shares repurchased. They tripled, quadrupled, quintupled the level of buybacks when the stock price dropped below $1,200. What the management is telling you is below $1,200, we are a screaming buy. We think we are extremely cheap. Anything below $1,200. It makes sense to me. My average price has been $1,100 or something like this. So I'm below this, and I'm happy with my target price, with my price on average, actually. So yeah, it's quite bullish. The management is clearly telling you we are going to size up our buybacks for anything below $1,200. And they delivered because they did their biggest buyback ever. Boom, boom. Let me show you on a quarterly basis. The free cash flow they generated during this quarter was $200 million, but they did $600 million of buybacks. Biggest buyback ever. And this is lovely. Let me continue because I have some comments. So, for the summary, I'm aware this video is long because this video is complete. For the summary, and I'm not done, it's a strong earnings report, and it was to be expected. Equifax, TransUnion, cross-reading, new pricing policy, counter-attack, it was to be expected. Do you double your prices? Of course, you will grow your revenue. It's the first quarter with price hikes and a success fee, a new monetization system that will work. So it was to be expected. This quarter shocked many first-time buyers of FICO. I see a lot of people right now on Twitter saying, wow, amazing quarter. I mean, you can tell that people are new to FICO. They don't really understand FICO, the moving parts, etc. And it's okay. They will learn with time. But it is shocking for a lot of people. You had the information before. The growth comes almost entirely from massive price hikes on mortgage scores, from $5 to $10. I want to see during the earnings call what is the mix of this, and what is your plan in the future. Do you plan to continue your price increases from $10 to $15 to $20? Given the potential investigation you have with the Senate, what is happening over there? More volume and more pricing. Now, let's see if the VantageScore change will impact the full year 2026. Let's see the market share they can take. I think the market share is less than 5% from VantageScore. Let's see if they talk about this during the earnings call. They did their biggest buyback ever. That's very smart. They can and they will continue to do buybacks if the stock continues to drop. I will not call for the bottom of this stock. I don't know. Anything can happen. When they released the new pricing structure in August, it's September 2025. You see this big candle here? I don't know if I can zoom in here. They announced a new pricing policy to cut the credit bureaus. The stock jumped 20% in one day. People celebrated too early because the stock went down and rebounded and then went from $1,000 to $800 to $1,000. People celebrated too early without much visibility. The stock went down. So now the stock is up 10% today. I am not celebrating at all. That's too early. The stock can go back down to $1,000, $900, $800, and I will buy the dip. I'm happy to buy the dip. Okay? So I don't speculate on what will happen in the short term for FICO. Anything can happen. It can go up and then in 1 week it goes down. If it goes down, I will buy more. That's what I can tell you. Capital allocation is extremely simple. Zero capex, zero dividends, zero M&A, just buybacks. Buybacks. They raised their guidance significantly. So valuation is cheaper than it seems. I showed you before, that's a PE ratio of 28, not 30, not 35. This report was exactly what I expected. I called for a raise in earnings per share guidance from 25% to 35%. They delivered beautifully. I showed you before, a few days ago, it was exactly what I expected. I expect a stock price jump of 5% or more. It was bullish, but you still have clouds of uncertainty. So let's see today. I don't know when you will watch this video, but as I'm recording this video, the stock is up 10%. Let's see. It goes back down. I would just let it run. It can go back to being flat. It can end up the day being down. Anything is possible. I will not speculate how the day closes for FICO. I think the disruption risk is real with a new competitor in town. To be monitored. Next quarters will be very important with new competitive environment. Because VantageScore was just approved, announced, officially released. Okay, in the next quarter, we will see if they get some traction in the future. It's so recent right now, so we don't have the data. Let's see in 6 months, in 9 months, in 12 months, if they get more traction. Let's see if they lose their monopolistic position. Let's see. I'm not calling victory at all right now. It's a little bit too early to say it's the bottom, they have won. No, they have won a battle, but not the war. It could be a good title of a YouTube video. FICO won the battle, not the war. Yeah. And it's exactly what I think. It's a short-term victory, but in the long term, it's too early to judge. Maybe the stock drops from there, and I will buy more as it drops. If it drops below $900, $800, I will buy more. Now, let's see what they have to say on the call. What to monitor on the call? Right now, I will put the call. You will listen with me as if we are listening together to the earnings call. I will make some pauses. I will stop and add some commentaries as if we listen to the call together. So it's kind of an interactive way of listening to the call and not being alone in front of your screen. And I want to monitor a few things. First, what is the impact of VantageScore? 2, the potential market share loss. 3, the new regulatory pressures. What about Bill Pulte and Josh Hawley? Sorry for my accent. I'm French. I don't know how to pronounce some English names. But you have people, political people in the US that are investigating to attack FICO, saying their prices are too high. I want to break the monopoly. So they are fighting FICO, and that's not good. Last time it happened, it was in 2020. And after 9 months, they dismissed the attack, and FICO had to pay nothing, 0 fine. So let's see right now how many months it will take. But yeah, any new updates on regulatory environment? Next point, the continued pricing power. Are they going to announce from a new price increase from $10 to $15 to $20, or for the success fee that's $65, but maybe it will be $75 or $85? I mean, what is your plan in the future? Also, the direct lending program with 10T. So that's I told you before, $1, $65, success fee. I want more information about this. And finally, how they are moving away from the credit bureaus. I told you, I'm checking all the reports from all of them in this industry. And Equifax had an earnings call last week. The earnings call was 1 hour and 40 minutes. And they were very aggressive to FICO during their earnings call. They are fighting. And I don't know how the fight will go in the future. Nobody knows, actually. But it seems like the credit bureaus don't like FICO. In the past, there were partners. They were using an algorithm with data of some companies, the credit bureaus. You put this in the algorithm. They are friends and partners. And now FICO is telling you, I'm doing it everything alone right now. I don't want you to be my friends anymore, so I'm just cutting you off. Okay, so that's how you cut your friendships like this. Of course, credit bureaus are angry at the moment, and they will fight back. And all their slides from Vantage for Equifax had two figures. One including FICO, one excluding FICO. They want to show the world, the credit bureaus want to show the world how great they are without FICO. It's like a good divorce. A good divorce, and you want to feel independent and proud, saying you don't need your loved one to be strong, independent, with a clear mind, with a growth target, and nice margins. The analogy of divorce is quite true here. So it's a painful divorce. People are screaming. People are attacking each other. But let's see how it goes. You never know how a divorce can go. You never know how this kind of relationship can go in the future. Wait and see. This is why I'm not calling for the bottom at all for FICO. I will not be surprised if we go back down, up, down. It's a mess. So let's see if the call adds more visibility towards our investment thesis. I will do it through Fiscal AI, the same website where I showed you some charts, some buybacks, etc. It's the website I've been using for years, and I highly recommend you use Fiscal AI. You have a discount code in my description to use Fiscal AI for free. You can try it out for free. You have a trial period. You don't put your credit card. Click in the description, click on the link, try it out for free for 2 weeks. And then if you like it, it will get cheaper if you use my link. 15% cheaper if you use my link. So I highly encourage you to use Fiscal AI. You have the financials, you have the chart, you have all the numbers, you have the data in a few minutes after the report is being released. And you click on Investor Relations, you have the track record of all the slides, all the earnings presentations, all the proxy filings, all the conferences, the report, the slides, the transcript. You have an AI summary. You can click on it. And if you are lazy, boom, you have an AI summary of what was said during the call. That's it. and everything is integrated. This is a lovely website. You have an insider ownership, the estimates from Wall Street, and for free you have research from Morningstar, completely for free if you use Fiscal AI. So yeah, very good website. So April 28th, let's see what they say. Now that we know what to monitor, the call is 1 hour long. I will add some comments along the way. So take a cup of tea, take a cup of coffee, stay with me, and let's start. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video.
And thank you for attending FICO's second quarter earnings call. I'm Dave Singleton, Vice President.
Okay, you start with some disclaimer as always, and then we start.
Thanks, Dave, and thank you everyone for joining us for our second quarter earnings call. We had a very strong quarter and a great start to the first half of our fiscal year. Based on our results and outlook, we are increasing our fiscal 2026 guidance. We reported Q2 revenues of $692 million, up 39% over last year, as shown on page 5 of our investor presentation. For the quarter, we reported $264 million in GAAP net income in the quarter, up 63%, and GAAP earnings of $11.14.
Okay, you know what? Let me just scroll down, because if that's only for the numbers, we have already analyzed the numbers. So let me scroll down and see if we find something new. Real return capital to shareholders, average price of $1,250 per share. We are growing nicely, blah, blah, blah. We have already analyzed this. And they talk about this. Last week, we issued a statement on our website in response to the FHFA and FHA update on credit score modernization. Yes, it is what I told you. Like, it was a public announcement saying the Vantage score was approved. And a couple of hours after this, you had a blog, a FICO blog. And they said, we are happy for the decision. Guess what? We have a new FICO 10T score that was also approved. It's $1 per score. This is the blog they're talking about. We upload the initiative to get FICO score 10T into the market in the coming months. FICO 10T score is the most predictive credit score for all borrowers, I agree, including first-time home borrowers. Yes, because it includes things from daily life, like utility bills. FICO Score 10T incorporates rental and utility payment history, enabling more consumers to qualify for mortgages. Yeah, exactly like we've had in the past. You have Vantage Score that did this. You have Upstart, another company that nobody remembers, that did this with AI at the time in 2021. Exactly the same worries people had in 2021. And then this is new. Okay.
To support the goal of increased home ownership and bring the benefits of increased competition to the marketplace, we updated our FICO Score 10T performance model pricing in the FICO Mortgage Direct Licensing Program from $4.95 per score plus $33 funding fee to 99 cents per score plus $65 funding fee.
So this is new.
We anticipate the release of FICO Score 10T data in the timeline provided by the FHFA and GSEs. In the last quarter, we added 11 more lenders to our FICO Score 10T early adopter program. As a reminder, through this program, FICO Score 10T is made available for free with a purchase of Classic FICO. The 55 lenders in the program account for more than $495 billion in annual serviceable originations when evaluated using 2025 HMDA data and more than $1.6 trillion in eligible servicing.
Okay, this is new and it will get complex. Be ready for this. The new 10T FICO score has been approved, maybe already used, but they say we will provide more data later. At the same time, the bureaus are pushing this Vantage score and they are having partners, 200 partners, of which 40 already signed partners to use the Vantage score. So there is a war of attention. Who will use my score? No, use my score. No, use my score. Yeah, the Vantage score is getting some traction, but the sum of the usage of the Vantage score is in a couple of millions of dollars. I think less than $100 million of capital used Vantage score. And what they are telling you, what FICO is telling us, they have already 55 lenders in the program, the 10T score. It accounted for $500 billion. So you get the fair estimation of the market share. Vantage score 100 million, right? For FICO, 500 billion. I'm not sure. Is this the global market or not? I would maybe ask a question to compare the data model for model. But FICO score is so big at the moment. Anyway, they are pulling this new credit score, and it will be served in the future. Let me continue.
We're moving closer to the go-live dates for our next-generation cash flow Ultra FICO score with our strategic partner Plaid and the FICO Mortgage Direct Licensing Program reseller partners. We continue to actively work alongside participants to support testing on both initiatives. As AI adoption accelerates, we recognize the need of stakeholders to weigh the associated opportunities and risks. At FICO, we view AI as a tremendous opportunity that we've committed significant resources to for several years. In the scores business, AI is limited by strict regulatory requirements on credit underwriting outcome explainability and model governance.
No, AI will not be a tailwind to FICO. I don't believe this is the case. I believe this is just the management speaking here, not true.
In addition, our scoring models are supported by proprietary data access, mainly with credit bureaus, and deep ecosystem integration.
Yes.
Across both businesses, FICO has been issued 137 AI-based patents, which include patents in blockchain.
I mean, AI will help the software business, but we don't care about the software business. For score, it's the algorithm. The FICO score is an algorithm that has been used for the same thing for the past decades. The same algorithm. It is getting a little bit better here and there, but it is so regulated. You don't want to change it with AI. It's a system that works. And if you put AI in a score, you change the nature of the score. And people like FICO because it doesn't change. It's a language. If you use AI, it will change the language so people will get not so relaxed. People will get stressed. They like the reliability of a FICO score. If I'm a banker, I don't want to change. It has worked for 30 years. I don't want you to change the formula. So don't change the recipe. I can pay you more. That's fine. I want safety. I'm lazy. So I don't think AI will help the score business meaningfully. For the software business, yes, but it's not meaningful.
Blockchain technology that are helpful for traceable and explainable decision-making. The type of market-leading innovation that will be in high demand as businesses seek ways to safely deploy AI analytics in highly regulated industries.
Yeah, even maybe for the FICO 10T score, utility bills, where you live, the kind of job you have, the kind of partner you have, what's her job, his job, your partner. Maybe you can use AI to cross-read this, but no. If you are a shareholder of FICO, be careful of this. AI will not help you.
In our software business, as shown on page 13, FICO platform is architected
I don't care.
to be agentic architecture powers a real-time, always-on customer profile engine that delivers hyper-personalized consumer experiences where every interaction is informed. FICO transforms 70 years.
Let me just skip everything related to software. CFO. The CFO is talking about the numbers that we have already analyzed, so let me skip this. Scores metric. In the past, updated guidance assumes conservative scores volume. To reiterate, we do not anticipate share loss competition in any vertical. Okay, so they said it. Something we wanted to check, potential share loss. The message is clear. What is the market share of Vantage Core? 5%? 1%? 2%? 3%? Okay. Turning to our software segment, we don't care. Platform, no. I don't want to waste your time, so let me just skip what is not important. No. Platform, recurring revenue. You integrate AI. You're very proud of something meaningless. No. As a reminder, our guidance for 2026 for revenue reflects an expectation of lower point-in-time revenue throughout 2026 due to a fewer non-platform license renewal opportunities compared to prior year. We don't care. For a regional point of view, the business is mostly focused on America, in the US, obviously. We don't care about the international expansion. I don't want them to expand internationally. I think if they expand internationally, it would be a mistake. Okay, the margins were extremely high, and the debt is $3.6 billion with a weighted average interest rate of 5.5%, which is reasonable, given the growth rate they have and the buybacks they have. So they have to repay $1 billion in 2034. Okay. All of the debt is long-term, so they don't have to repay debt now. They have to repay that in a few years. And they did a massive buyback program, the single largest quarterly repurchase in dollars in FICO history. Yes, and it will continue. With our recent $1.5 billion authorization of more buybacks, strong free cash flow, and unutilized revolver, so unutilized debt, we have bought more shares since April 1st. Okay, so we have the data for the next quarter. It would be a Q3. They have already bought back $200 million of shares at a price of $1,000. Okay, can I check this? The earnings call, so today, April 28th. So it's almost for the whole month of April. They repurchased 164,000 shares. But we have the data. In March, they repurchased 300,000 shares. And in April, they repurchased 160,000 shares. So, oh, that's strange. Not good. Not good. You say the stock price is a screaming buy at $1,200 in March, so you buy more. Then the stock price continues to go down, and you buy less. Maybe they have to stop the buybacks 2 weeks before earnings. Yeah, you have like a blackout period. But even if you take into account this, it's a little bit stupid. No, I don't like this. I don't like, not coherent to what they say before. So you want to take this with a pinch of salt. When it was trading at $1,200, you say that it's the deal of the century. The stock drops and you slow down. No, don't slow down. Come on, take more debt. Exactly as they did in 2021. Take more debt, do more buybacks. Take more debt, do more buybacks. If you're so confident. So no, I don't like this. I don't like this at all. Okay, and then the CFO ends. And we have the CEO talking about transformation. Okay, let's see.
Thanks, Steve. As we approach the start of FICO World 2026, which is going to happen on May 19th through the 22nd in Orlando, we look forward to showcasing our continued innovations. The event brings together customers and partners from around the world to explore how real-time scalable decision-making is transforming consumer engagement. We remain focused on enabling deeper customer relationships through always-on personalization that drives strong business outcomes. The conference also provides a forum to connect with industry experts, share best practices, and advance initiatives that drive financial inclusion. We had a great first half of our fiscal year, and I'm pleased to report that today we are raising our full year guidance as we enter the third quarter. As shown on page 24 of our presentation.
We expect a growth rate of 35%. Let's start with the questions. Let's see if Wall Street analysts understand FICO like we do. You now understand the moving parts of FICO. What moves, what is important, what is not important. Let's see. First question.
Please go ahead.
Hey, good afternoon, and thanks for taking my question. I'm curious to start, Will, if you could talk about the philosophy behind adjusting your pricing model, going to the 99 cents up front. Appreciate some commentary. Thanks.
Yeah, absolutely. So that's a step in the direction we've been talking about now for several years.
Yes.
We have historically charged upfront per score. That's the historical way we've always charged for our IP. But what that does is it doesn't spread the cost across the rest of the value chain. And so a lot of the beneficiaries of the IP are not really paying for it.
I've been tracking the earnings call for years. They've been preparing for this answer. It's a scripted answer. I know it. I cannot prove it, but I know it's scripted. They know. It's prepared. They know this question will ask. And exactly the Hemnet model, you know, the Swedish real estate listing website I talked about. Spreading the cost across the chain. Yeah, it's scripted. And they are moving away from a fixed fee to a success fee. And I think it will work.
And so we have that cost concentrated up front. The whole idea behind moving to the performance model was to give us more flexibility so that we could distribute the value, the monetization of that IP over more players across the chain. And so that's really what we've done. In this most recent move to 99 cents plus a $65 funding fee, the idea was to encourage adoption of FICO 10T because we think that the most powerful thing we can do is really get FICO 10T established. And obviously it's already established in the non-performing market, but we'd really like to encourage wide use of 10T. And so this kind of pricing is designed to encourage that.
Great. Thank you. That certainly makes sense. And then now that Vantage Score is available to be used on the conforming mortgage market, do you expect, what percentage of lenders do you think would shift fully away from FICO to just using Vantage Score?
This is our next question. We had the moving parts, impact of Vantage Score, potential market share loss. What do they have to say?
Or do you see most lenders, if they are going to use Vantage Score, do you see them also pulling FICO during the mortgage process and then submitting the score ultimately that's most favorable to them to GSEs?
Well, I suppose we'll see how it turns out. But if you think about the decision process for those who purchase scores, if they're after the most predictive score, 10T is the answer to that. If they're after price, then I think we have parity. 10T at 99 cents is at parity with Vantage at 99 cents.
No, not really, but okay. I mean, you have $65 success fee more, but okay.
And so, on both predictability and price, we think we're highly competitive and frankly don't see good reasons to switch. Now, depending on how the FHFA decides to handle the gaming problem, there may be opportunities for Vantage based on the gaming. And so we'll just have to see how that unfolds. Although our analysis suggests that in a gaming scenario, if there's true consumer shopping for the best rate and the system is going to be gamed in that way, that originators and lenders would wind up pulling both scores.
Good point. There is a scenario when people pay for Vantage Score, but also pay for FICO Score to have more data and make an informed decision. Maybe it's possible, and it will help Vantage Score. What if in a few months the US makes it mandatory for lenders to use Vantage Score? People will have to pay for FICO, but also for free get the Vantage Score. Maybe they will get some market share by doing this. Maybe it's possible. It's a scenario that is bad for FICO, but it's a scenario that can happen.
Makes sense. Thank you.
Thank you. And one moment for our next question. Our next question will come from the line of Manav Patnaik with Barclays. Your line is open. Please go ahead.
Thank you. Will, for the 10T adoption, obviously that 99 cents is only available through the direct loan model that you have, DLP model. Can you give us an update on when that's going live, what the feedback right now is with lenders and kind of adoption that you expect there?
Yes, absolutely. So there's a few pieces to getting the direct license program live, and they're mostly in place. We're working on the last, kind of final details now. So we have 3 of the top 5 major resellers signed up. We are in deep discussion with the other 2 and fully anticipate that all 5 of the big resellers will be able to provide the direct license program. We also see a great deal of interest from the lender community for this performance-based pricing model. So there's pent-up demand, and we anticipate quite a lot of usage of this model once we get direct up and running. We do still need FHFA final sign-off on having the resellers calculate the score, but we don't anticipate any issues there because the math is identical and score, we've tested it, and the score calculated by the resellers is the same score as that calculated by the bureaus. It's on the same data. It's the same methodology. So although I can't give you a date, I can tell you that we're closing in on it.
I don't like the answer. Aaron, tell us a date. When is the new model live? And they were quite vague. Yes, we are not at the early innings, but at the end. But when? I don't like the answer. I want more visibility.
Okay. And then just in terms of, the historical 10T data coming out sometime in the summer, maybe just some help on how that process works. Like, will there be another pilot like they're doing now with Vantage Score once 10T is out and we're only looking for something realistically in 2027 for both to be ready to go fully live, I guess?
Well, the FICO 10T data, as you know, is with the FHFA and the GSEs, and it's up to them to decide when to release it. There's certainly a lot of market sentiment for being able to evaluate 10T and Vantage at the same time, and certainly by the time the GSEs truly accept Vantage, I think the market would like 10T to be available as well. So there's some market pressure to get this done, but I don't have the timeline.
Okay.
One moment as we move on. Please go ahead.
Hi, everyone. Thanks very much for taking my question. Well, I was wondering if you could just cycle back to the question. I think it was Jason asked about the pricing of 10T. And your comments that it's at parity with Vantage Score. I was wondering if you could talk about the philosophy or like how you think lenders will treat successfully in that kind of situation, and how we should think about that dynamic in that sort of comparison.
Well, I think the beauty of the way we structured this is that mortgage originators and lenders have a choice. They can continue to buy the score the way they always have on a per score basis, or if they prefer, they can move to the 99 cents plus funding fee. And the idea there is that it encourages very widespread use of the score in the prospecting phase, in the customer acquisition phase, in figuring out who's qualified for a mortgage, and frankly, with the goal of trying to encourage more housing and more mortgages, making the upfront score cost very low is likely to support that.
I love this. I love this. These 4 lines here. This is very important. They know regulators are monitoring them. There is somebody from the Senate or the Congress or somebody, the political area, called Josh Hawley. Sorry for my pronunciation, guys. Somebody that is very that is attacking the big tech a lot, like big tech, big data, Google, Meta, for child use of Facebook, Instagram, these kind of things. And he recently attacked FICO because of price gouging. And they say, the reason why the mortgage market is so bad in the US, affordability is so painful, is because of your fee. It's because of $5. And that is very funny, because I don't think this is true. Because of $5. I mean, the reason why affordability is so bad is because interest rates are high. Interest rates are at 5%. If interest rates drop to 3%, the debt is cheaper. People will get their house, get a loan and get their house. So Josh Hawley is not attacking this problem. Inflation that is high, interest rates that are high. They are taking $5 with FICO, and they think it will change the needle. Like, it will move the needle meaningfully in this market to move from $5 to $2. So Will Lansing, the CEO of FICO, knows this. They say, we are introducing a new pricing model of $1 to be trying to encourage more housing and more mortgages, which is not really true. Making the upfront score cost very low is likely to support that. So yeah, we are complying with you. This is the wording especially designed for the political people. Just, yeah, we are working with you guys. We are in your team to make people have their new house, affordability. But everybody knows it will not move the needle at all. Everybody knows it's not because of $5, $10. I mean, when you have a new house, you already pay thousands of dollars for the banks and all the fees to have a new loan. You buy a house $1 million, $500,000, $2 million, you pay thousands of dollars of fee. It's not because of a small fee. It's what, $5, $10? If you have a tri-merge report, it's $200. We don't care. It's not this. But they have to play the game. But FICO has to comply and say, we are trying, guys. See how we are not mean guys. We are very kind people, and we are complying with the new regulation. This is what I had, new regulatory pressures. So FICO is playing their game. They are telling people, we are compliant, we are kind, and we are happy to support the government. They want to crack down on this kind of difficult situation, low affordability, and we are helping. I don't think this is true. I think they are lying, but it's good for the sake of the business, because FICO is being attacked, and Josh Hawley wants to start an investigation with the FTC, the Federal Trade Commission, to investigate on FICO and their practices of price gouging. So for the moment, you have no investigation, but this person already said publicly he wants an investigation. It's the first move. And because it's a monopoly of price gouging. Now, first point, it's no longer a monopoly, you have Vantage Score. It's a duopoly. So boom, the first argument is dead. 2, they already destroyed the second argument of price gouging because of $1 and what they just said in 4 lines. So the 2 reasons why you could start an investigation are dead. I don't think you will have an additional investigation that will lead to the collapse of FICO. Just don't think this is true. Maybe I'm wrong, maybe I'm right, but I'm making a decision of buying the dip. So yeah, maybe I'm wrong, maybe I'm right, we will see. But I don't think this will happen. So yeah, the wording they use, the CEO is using clear words to appease the tensions. Yes, okay.
It really is up to the lenders which model they prefer. We leave it to them. We are, I've said before, we're largely indifferent as between the two models because it's about revenue neutral for us either way. But I think that each model meets the needs of different customers for the score in different ways.
Understood. Thank you very much for that. And just as a follow-up to the reseller readiness right now, I understand we're getting close to go live or starting to come into place. The bit I would love to get a bit more color on is just, I guess, what has, relative to initial sort of expectations, it feels like it's taken longer than expected. And I was wondering if you could talk about sort of what has been behind some of the prolonged process here.
I think that some of the expectations were a little on the optimistic side. We certainly didn't think it was going to happen in a couple of months. We thought that it would take a while to put this together. It's a pretty complicated program. Not a complicated program, but there's enough moving parts that require validation and testing that we knew it was going to take some time. This much time, I would say we actually believe that it would be up and running by now. I would say that we're close. And as I said earlier, it's really up to the FHFA to sign off on the calculation of the scores by the resellers, and then we're pretty much there.
So the Vantage score is not approved officially and up and running. This is why I will not celebrate too early. They can take more market share now. You have a new battlefield. Next question.
Thank
you. Well, just following up on the timing of 10T, just to understand, is there a sequence of dependencies before the FHFA kind of makes it available in the sense of like releasing the historical data? Obviously, you've got to have the systems and everything ready, but are there other things that we should be aware of, or is it just kind of once the systems are ready, they can release it whether or not the historical data is available?
No, I would say that there are not a bunch of additional things that no one knows about. I think we have to get the 10T data out so that people can test it, and then the GSEs have to accept 10T, and that's it. That's all that's required.
Got it. And then in terms of just switching away, can you maybe talk a little bit about the outlook for expenses here? I noticed you talked a little bit about, incremental scores marketing expense. What should we expect there? And then other than, kind of the step up that's related to the annual FICO World Conference.
Yeah, it's not all that material. There'll be some expense. It's not, I think you can kind of back into it when you look at our guidance numbers, but it's not all that material. But we've got some, there's some additional personnel expense. We got expenses around FICO World. There's some other types of marketing we're doing. When you see more growth on the software side, that's not 100% margin either, right? There's cost of goods sold, so you're going to see some expenses there, but none of it's all in there.
Yeah, we don't care about the expenses for this business. This is not what is important. That's a strange sentence to say. I'm very well aware of this, but costs are not important if you want to be a shareholder of FICO. This is not in the top 5 of the most important things about FICO, not even in the top 10. No, we just don't care. And they also run a software business, so you have costs. Employees, DNA, R&D, all these kind of things when you have a software business.
Okay.
Thank you. And one moment for our next question. Please go ahead.
Yes, hi, thank you. So first I wanted to ask about the very strong growth that you saw in mortgage revenue this quarter, up 127%. I think we know about your pricing, but it implies pretty strong volume growth. So I'm just curious if you can talk a little bit more about some of the factors there.
Wow, the echo is not from your computer, not from mine. That's for this lady's microphone. Great question. Thank you, Faiza. We had this question. The price versus volume, continued pricing power. How far can the pricing go? And what is the mix between volume and pricing? Please, the CEO, tell us the mix to reach this 127%. Please tell us. Don't be vague. Please tell us.
Yeah, we had decent volume growth. I think it was a pretty good quarter. There was a period of time there where interest rates dropped a little bit and saw a little bit of an uptick here, and I think consistent with what we hear from the bureaus as well. So it was a decent volume quarter, probably better than we expected when we gave our guidance. But again, we guide very conservatively because it's really difficult to know what those numbers might be.
Okay, so they said basically the same as the bureaus. So my guess was pretty correct, saying roughly 20%. Like Equifax and TransUnion. So I think 80% of this comes from pricing, 20% comes from the volume. So what's 20% of, let me calculate, 0.2.127, 25% points coming from volume, 100 points, 102 points coming from pricing. And if they don't raise their prices next year, this growth rate will collapse. Okay, so similar to the credit bureaus. I think our guess is correct. Okay.
Okay. And just on the software side of the business, again, pretty strong bookings, really strong ARR growth on the
Let me skip the software.
So
Next question.
Yeah, thanks. From a earlier question, it sounds like the answer may be TBD, depending upon what FHFA decides to do. And I don't know, do we have to wait for the selling guidelines? But the question is, what's your understanding? Because I think the language is the enterprises cannot accept scores from multiple models. But has they said anything about if a underwriter can pull scores from multiple models earlier in the process? Or is that waiting for the selling guidelines to know the answer?
I think that's waiting on the selling guidelines. I mean, I can't speak for the GSEs on that.
Yeah, too early.
Okay. And then do you have any sense of what went into the approval process of the 21 initially approved lenders for Vantage 4.0? Were they asked to apply by FHFA? Is there any sort of like commitment, how intensive of a process it is? Just trying to figure out if that's a meaningful signal or not.
Okay, maybe you don't understand this question, and that's normal because that's not very well covered online. The Vantage score, so the credit bureaus, are very marketing driven. They want to show the world how great their new scoring system, the Vantage score, is. So they are partnering up with 240 partners, 240 companies, if my memory is correct. And out of these 200, you have a couple of them that already accepted. Small banks that already accepted. And they said 21% approved lenders. I think that's more than this. That's in the 40-ish range, but maybe I'm wrong. Anyway, some people already approved and accepted to work with Vantage Score and say, okay, we'll use your score. Maybe we can use both scores, but maybe we'll use your score. And the question is, were they forced to use the score? I mean, what are the incentives over there? Were they forced by the government to accept this? Because people from the government, they want more competitors. So maybe they will push this Vantage score hard. So maybe they were forced to accept. Let's see what the CEO says.
We don't really have a lot of detail around that program. You know, obviously we weren't invited to be part of it. And so we just don't have the details. You know, it remains to be seen what happens there. But our understanding is a fairly manual process.
Yeah, you had some internal data from Bill Pulte that said that they almost forced people to use Vantage Score. It's a little bit too early to say this publicly, but I would have a few guesses. They did not force, but they implied that they are kind of forced to use Vantage Score. But these banks did not know much. I mean, they did not know what was happening actually. So they were feeding them with Vantage Score without clear approval, like almost forcing them. And it will work. I think it can work with this strategy. You force them to try. If they love it, they keep it. So nothing bad here. They will have to choose.
Okay, thank you.
Thank you.
Next question.
Thanks for taking my question. I know you just announced the FICO 10T pricing, but I just wanted to understand what's your pricing strategy over the midterm. Is there
Wonderful. This is our next point. Continued pricing power.
Still a gap between price and value? And as you think about it, how do you think about closing that gap? Would you also consider alternative pricing algorithms, including the percentage of the loan amount for the success fee? So any color there? Thank you.
Oh, good question.
You know, as you know, we've talked about a lot of different approaches to pricing for our IP. And those are under constant evaluation and study. And the balancing act is, we don't want to shock the market. We don't want to make precipitous changes. In fact, we don't love change. The market works really well the way it is today. And so we don't like change.
So don't expect AI to change FICO. Don't expect a meaningful change because of AI.
That said, there is a case to be made for low pricing upfront. There's a case to be made for shifting around the monetization of the IP across more than just the first purchaser. And so we're always evaluating those kinds of things. Our philosophy has not changed. What you see is the first couple of steps in the direction of what we've been talking about for several years now.
That's very helpful color. And then maybe just on the Vantage Score LLPA grids, FHFA mentioned that they are taking into account proper credit risk accounting in order to make sure, and that's why those matrices are different compared to FICO. I was wondering, based on your experience, what are the key credit risks that they would consider when they are designing these matrices, and why should FICO or FICO 10T get a preference? Thanks.
Good question.
Well, so again, I can't really speak for the way the GSEs are thinking about it. But what we believe is that in these LLPA grids, if you're going to account for risk, there's going to be price differential. There's going to be gaming that goes on. What kind of risks might be accounted for? I don't know how they account for them exactly, but certainly you could have very different credit default risk for Vantage versus FICO. You could have very different prepayment risk for Vantage versus FICO. As you know, the Vantage data only goes back to 2013. It's never been tested through a full cycle. And so there's a lack of understanding, not for want of trying, but the data is not there to understand how Vantage will operate through a full cycle. And so, I'm not really sure, what does that mean? It means that, downstream, investors are going to demand some kind of a premium for the lack of understanding around prepayment risk and credit default risk. How that gets translated into the LLPA grid, the G fees, hard to say. And then because the pricing will be different for FICO and Vantage, and we guess that sometimes Vantage will have better pricing for a consumer and sometimes FICO will have better pricing for a consumer. It's going to create some real headaches for the GSEs. So we'll see. We'll just have to see how they solve that problem.
This is the bear thesis. Some people are bearish FICO and they say the pricing will be relatively the same. In the LLPA grid, that's a little bit too complex. And the CEO of FICO says, I don't know, we don't know, it's too early to judge. So it's all about speculation at this moment. The bulls, the bears, nobody knows anything. So I will not speculate on the comparison between these two models. But they are right in saying FICO has more historical data because they cover 35 years. And Vantage data goes back to 2013. And what was just approved was only 2 years between 2023 and 2025. So FICO has better data, a longer track record. But we will see for the pricing model how it goes.
Very helpful.
Your line is open. Please go ahead.
Hi, thanks. Good afternoon. With the direct licensing program, it sounds like you're awaiting FHFA approval. Are there other implementation hurdles they have to overcome among the top 3 resellers that have signed up so far? And can you talk about why the remaining 2 out of the top 5 are taking a bit longer to sign up?
I would say that there are not other factors, nothing meaningful. So we're really just waiting on approval from the BSCs and from the FHFA. And then in terms of the 2 that haven't signed, I can't get into the details, but we're very close.
Okay, got it. And then with respect to your outlook, can you elaborate on what assumptions are baked into your full year guide with respect to Vantage Score adoption, the timing of the direct licensing model going live, and performance fee adoption?
Yeah, we anticipate no loss of volume to Vantage in this fiscal year. That's in our...
Again, that's the second time they say this. They don't expect market share loss.
We anticipate no loss of volume to Vantage in this fiscal year. That's assumed in our guide. We are, as I said earlier,
Let me stop. I want to see what is the market share of Vantage Score. Because in Equifax, the credit bureaus, they also have a guidance. And in their guidance for Equifax, they also estimate that Vantage Score will not take any market share. That's strange. It sounds strange to me. It looks strange, it sounds strange, so it's strange. FICO is assuming the market share will not move. The credit bureaus are assuming the market share will not move. But FICO is very confident, they are the best and best in town. And Equifax is here as a challenger and say, we will beat you up. But they are not they are conservative in their guidance. They assume no market share change. Either they talk too much and nothing will ever change, and bulls will sound like geniuses in the next few years, or they are lying. the two companies have the same conclusions with the same guidance. I mean, if I want to shock the world, and if I'm Equifax, I'm the bureaus, I am updating the guidance saying we are so confident that we think we are going to take market share, so we are upgrading our guidance. It is not what they said. They said we keep our guidance the same because we assume no market share improvement. Or either they're being very conservative or they think nothing will happen. And nobody knows. Good luck investing in this situation. So assume guidance, okay.
We are, as I said earlier, we're in roughly the same place financially, whether they go with the per score model or the performance model. So it's revenue neutral. There's a little bit of a timing difference because with the performance model, the funding fee would trail the initial fees.
Yeah.
So, I mean, there's some minor differences, but I would say on balance, it's pretty close to a wash between the two. So it doesn't really matter when the adoption occurs. I suppose you could argue that if the adoption of the direct license program is delayed, that's beneficial to FICO in the very short term, from a timing standpoint, but we don't think about it that way.
Yeah, and we do have some lag built into the guidance based on the assumption that the performance model will go live, and we'll have some revenue to push from late this fiscal year into early next fiscal year, because again, the timing is described.
Next question.
Your line is open. Please go ahead.
Hi, everybody. Could you start with the 127% year-on-year growth in mortgage? I understand that your rack rate is widely known. FICO layer on top of that volume assumption, it's still a bit below. So maybe were there any prior year pricing adjustments that feathered into the present fiscal year, or just anything that might have given that an extra booster? Is this sort of the rate you guys think you can continue at these volume levels?
Yeah, I mean, not really. I mean, there might be some difference in the unit cost. I mean, there's some. Without getting into a lot of detail, that some people were on a little bit lighter rate last year and we're up to the full rack rate this quarter. But it's primarily, just the new rate and then the additional volumes we saw.
Got it. Thank you. And then maybe shifting to, usage of the FICO score.
Sorry for the bad microphone.
Or overall, I know there were some remarks about, stepping up expenses for the scores business, introducing the new version of Ultra FICO. If you could just talk about your investments in innovation in the scores business and how that sort of benefits the franchise you guys have there, that'd be super helpful.
In the scheme of things, the investments in incremental expense is not large. Okay, just to be really clear. That said, we are constantly investing in innovation, developing new scores. Ultra FICO is, although we've talked about it for several years, it is very much on our minds, and we have a plan. Which we're going to talk about at FICO World next month. But I can't go into the details now, but Ultra FICO is likely to be a pretty significant factor in the scores business in the future.
Next question.
Great. Thanks. Good afternoon, guys. I wanted to start off on software.
Let me just skip this question. Software is not important. Growth, customers, no adoption, platform, customers, highly profitable, there is balance. It's that's about software, I just don't care. As a follow-up, and then scores. Okay.
Got it. That's helpful. And then as a follow-up, wanted to switch over to auto origination scores revenue. I guess it did decelerate a little bit this quarter. Obviously, I think the comps are getting tougher, but want to see, at least directionally, if you guys could give a little bit more color on what drove the year-on-year decel between tougher comps, pricing changes in calendar year 26, or any changes in origination volumes or trends that you guys are seeing?
Yeah, it's really the tough comps. The volumes are not growing as rapidly as they were. The pricing is relatively consistent. The 26 price increases is consistent with 25. I think what you see is that the comps are difficult, and there's probably a little bit of mix shift there in terms of the pricing tiers. That some of the lower unit cost pricing tiers are gaining the volume from those that are higher unit cost. So there's some of that happening in the auto industry.
Next question.
Your line is open. Please go ahead.
Great, thank you. We've talked about this in the past, but can you just update us on your understanding? What's the data show you in terms of what the market share out there is for Vantage Score, in credit cards, autos, personal loans, and also non-conforming mortgage loans? What's their market share right now?
Thank you, Craig. Thank you. What is the market share of Vantage Score? They talk too much, but we want to know how big they are. What is the market share?
And we'll go from there.
I guess it all depends on how you measure it, because if you ask them, they would tell you they have significant market share in all those things. Near as we can tell.
Oh, this is good. Yes, that's okay. So they know exactly what is happening. Okay, I think most of these earnings call answers are scripted. I think FICO knows exactly, the management team knows exactly what they are doing. They know exactly what is happening. They know exactly they will win, how they will win. So I guess it all depends on how you measure it. If you ask them, the Vantage Score guys, the credit bureaus, they will tell you they have significant market share in all of these things. Boom! That's a clear attack, meaningful attack. I mean, FICO's Equifax started. I listened to the earnings call. They were very aggressive to FICO. So just FICO is fighting back. That's a divorce, guys. That's a divorce. A friendship that ends. Or a divorce if you want to be more mature. Anyway, what's your guess on the market share? I would say less than 5%, to be honest. I don't think it's more than 10. Crazy. More than 15? Impossible. I think it's less than 10. I think it's less than 5. But I don't. Maybe it's 5. Maybe it's 4. I don't know.
Nobody's paying for Vantage scores, and the bureau sends along a Vantage score for free when someone buys a FICO. I guess it all depends on how you measure it, because if you ask them, they would tell you they have significant market share in all those things. Near as we can tell, nobody's paying for Vantage scores, and the bureau sends along a Vantage score for free when someone buys a FICO score. So, when you see the big Vantage score volumes that Vantage talks about, you should know that they're largely unpaid for.
Exactly what we've been saying for 1 hour. They are getting fed Vantage score for free, and the credit bureaus are very proud of saying, we have a widely used Vantage score. No, you are giving them for free. Of course the numbers will go up.
So, is anyone using them? Don't know. Is anyone paying for them? Our sense is not much. And so, it's pretty hard to triangulate on what their market share is. I mean, I think it's trivial is what I would say.
And I think you see that in our numbers, right? I mean, if we were losing market share, you'd see it in our numbers, and you don't see any of that. We have to report our results. They're audited. They don't have that same obligation. So, there's a lot of scrutiny on what we produce, and we back it up with actual numbers that are verified.
So just to be clear, if you had a ballpark, you think it might be 5-10% market share? Maybe it sounds like
not
even that.
No, if I had the ballpark, I would call it 2%.
Okay. So then on the
2%? All this talk for 2%? All this aggression, all this bad talking publicly, all this 1 hour and 40 minutes long earnings call from Equifax for 2% market share? Well, now that we have the figure, we can compare. I mean, it's only the start of the battle, the start of the war. So let's see if in 1 year it goes from 2 to 5, from 2 to 10, to 10 to 12, to 12 to 20. Let's see. It's too early to call victory. I would not celebrate. It's very low. Let's not kid ourselves. It's very low. But it can go up. What if the government helps them and pushes the Vantage score to force feed everyone with the Vantage score? The market share can go from 2 to 6. Yeah. But it's very insignificant at the moment. They are talking too much.
Non-conforming part of mortgages, you're saying probably the same thing, right?
No, on the non-conforming part of mortgages,
zero?
I don't think any share at all.
Okay, so
just to be really clear, in the non-conforming market, the lenders use FICO Classic and they use FICO 10T, and they don't use Vantage.
So what's...
Now you have to see if they are lying or not. Normally, the management team says the truth most of the time. So if they say very clearly, on these markets, we have a monopoly, most likely it's true.
All this worry out there that AI, put that aside for a second. All the worry out there that Vantage score is going to take significant share just because of the changes from the government standpoint. The rest of the market here is, you guys have been, Vantage scores have gone up against FICO for 20 years, right, since 2006. You're telling me it's roughly 2% market share. Give or take.
We don't know. No one knows.
What's going to change, though? But what's going to change here on the conforming mortgage side of things here that they're going to get significant market share? And that's the theory out there for a lot of people. What's the case there that you can possibly see?
Craig, congratulations. You have the best questions. We have found the best analyst during this earnings call. Coming hard after hard questions. Tell us the numbers. Wonderful, Craig. Congratulations, Craig. Wonderful work here. Wow.
Look, I am not going to make the case for how Vantage takes market share because I think we're competitive on price. We are far more competitive on predictiveness. We have a better score than Vantage. there's not a good reason for them to take any share at all.
And the management gets defensive. Wonderful, Craig. Wonderful job. Well, boy. Wow.
Okay, my final question then is, why did you lower the upfront fee down to 99 cents from $5 then?
Two reasons. One is to
I feel like watching a movie is great.
Be competitive with Vantage and to have a low entry point and encourage widespread use of the score. And second, to encourage adoption of FICO 10T. That's a pretty classic approach to launching a new product, is to price it so that people use it.
But again, you're not worried at all that Vantage is going to take any meaningful share from you on the conforming mortgage side, right? That's what you're saying.
That is correct.
Okay, great. Thank you.
Oh boy, I love this exchange. Guys, they say if you find a job you love, you will never work one day of your life. It doesn't feel like work for me. I just love this. This is so good. So, clear fight, best analyst in class, Craig. Wonderful. Congratulations, Craig. The management gets defensive. Why are you lowering your prices to $1 if you're so confident? Why do you want to lower your prices to $1 to compete with VantageScore if you feel like the boss of your universe? If you are the boss of the arena, why do you lower your price? It's a great question. And the management team doesn't know really how to answer. In the prepared remarks and the first question they said, to have a more competitive environment, so to appease regulators. But when you push a little bit more, maybe they are worried. Maybe it's more about competitive regulation. What I think is happening is the government is helping VantageScore. VantageScore is giving scores almost for free. So FICO doesn't want to take any risk. And they say, from day one, we are going to destroy competitor. We are going to destroy the new competitor in town. You have a score for free? Okay, we are also delivering it for free. We will not lose our market share because of price. We are happy to lower our standards, lower our price. Well, you have the success fee after it, but just we are going to compete on price and we will destroy you. We don't want to lose our monopoly. They are fighting back. I think this is really what is happening for Fair Isaac. Great earnings call. Maybe the best earnings call we've had in a while for Fair Isaac. And I'm listening to all of them.
Thank you. And one moment for our next question.
Next question.
Please go ahead.
Hey, thank you so much. I'm just wondering if you have any feedback to share from the securitization market in terms of score reference in light of all these developments. Thank you.
Everyone's done their own market checks, and we have to. And I would say that the securitization market is not ready to accept Vantage. There's some hurdles to be overcome, and so we'll see how that all unfolds. I don't have a lot of insight there. I mean, the market is still all FICO. I think something like 20 mortgages have been securitized, with Vantage scored paper, and which is obviously less than 1%, less than 0.1% of the most recent securitization. So it's not real yet. We'll have to see how the market reacts.
Thank you. And I know we're getting some data released over the summer from the GSEs. Was wondering what you're expecting that release to entail and how you think it might validate the predictiveness of FICO.
Well, I think that I can't give you a date for when the FHFA will release the FICO 10T data to the marketplace, but we're certainly not standing in the way. We provide the data, we're ready to go. In terms of validating the predictiveness, we have white papers posted on our website that actually analyze FICO 10T versus Vantage and provide insights on credit default risk and prepayment risk and the differences. We qualify 5% more borrowers. I mean, there's a lot to see there. That's already been done. But then if you don't believe FICO because it's self-serving, I'd encourage you to look to third-party analyses as they come out, because I'm sure they will. And you're going to see a lot of analytic work around this topic in the coming weeks and months.
Okay.
Your line is open. Please go ahead.
Thank you for taking my question. So the AI disruption narrative hasn't gone away. Could you please talk about why it's very hard for whatever Vantage or a third-party AI platform to come in and create a more predictive credit score, which will be adopted by lenders and consumers if they can offer a lower price? Thanks.
Well, you can see when people have been following FICO for a while, and you can see people that have been following FICO very recently. This is all what I can say from this question. We've had the exact same worry with an AI score with Upstart in 2021. It completely failed. So yeah.
Okay, so there's two different things there. One is AI versus the current credit scoring system, and the second is within that, more predictive. So first, I would say with respect to AI displacing the FICO score, we have a really well-defined body of law, fair lending laws, which are designed to protect consumers, to ensure that there's not discrimination, ensure that consumers are treated fairly, and that requires compliance with all kinds of things that our scores take into account. I mean, just one small example would be redlining, which is not allowed in the United States. Is it a predictive factor? Yes, it's a predictive factor, but it's not allowed. And so you can't use redlining as a factor in a credit score. Well, AI doesn't. AI would find 100 other ways to get to the same result. And so the regulators are not going to be comfortable with AI making underwriting decisions when they're not explainable, when it's a black box, when they can't demonstrate that discrimination is not occurring. So
exactly. That's very clear. The management team knows exactly what is happening. The explanation is very, very clear, and I think this is 100% true. The regulation is too hard. As long as AI will hallucinate, as long as AI will have an error rate, it will be a black box. Regulatory speaking, we want safety. So we'll keep using all models because they work. It's too much of a risk to integrate AI. What if you have a bug? What if you have a problem because you tried something new? The shock you will have in the global economy. Too many risks.
That's kind of the core problem with using AI in underwriting. I mean, AI is great in a lot of things, but using it in underwriting, the biggest play is that it's going to get around the rules and regulations of the fair lending laws. Now, you're probably aware that FICO scores carry with them 32 reason codes. So when consumers turn down for credit, they get a letter, or the line is not increased on a request or whatever. They get a letter, and the letter says, "Here's why." And that reaches into the FICO score and the reason codes, and those reason codes are shared with the consumer. And so there's a level of comfort with the regulators and with the consumer that they understand what's going on. I would also point out that the experiment with AI, and some of the black box underwriting that was undertaken several years ago by Upstart ended with the CFPB shutting it down. So I think there's some real.
God bless. God bless. What an unbelievable earnings report. All the things that I've been saying for YouTube for months now, everything is inside this earnings call. I hope this earnings call will give a lot of visibility to FICO and will give a lot of new information to new shareholders, people that are studying FICO, doing due diligence now, that just started doing the research now. You have everything. They just mentioned Upstart and they were shut down. They completely failed. They were growing triple digits. They were signing deals with regional banks. But guess what? It was only temporary. Then everything collapsed. Wonderful. At the time, it was not called AI. It was in 2021. It was called machine learning. And they failed. This is great. This is great. Let me continue.
Challenges. Not that, I would also point out that, the experiment with AI, and some of the black box underwriting that was undertaken several years ago by Upstart ended with the CFPB shutting it down. So, I think there's some real challenges. Not that it'll be this way forever, and we are prepared for the day when AI is appropriate in underwriting. We have patents in the area of explainability and ethical AI, and so I think we're in an advantaged position. But I would not hold my breath. I think that's going to take a long time.
Yep.
And then on predictiveness of the score, I would tell you that our latest and greatest score is more predictive than Vantage, and frankly more predictive than any other score out there. The only asterisk I would put on that is there are lenders who build proprietary scores on top of FICO, and they leverage their first-party data, and so they have incremental data and get incremental signal out of that. And so there are some proprietary scores that are really excellent, that are most typically developed on top of FICO.
Got it. And then maybe quickly on LLPA, have you heard of any of these 21 lenders receive the updated LLPA grid from FHFA for the pilot? And do you have any expectations that when the new grid will be made public? Thanks.
No idea. I've heard nothing. I encourage you guys to keep asking the questions. What's going on there? I think it's a manual process.
Okay. No clear indication of the new grid. Okay, next question.
Please go ahead.
Hey, good afternoon, guys.
We are slowly coming to the end of the earnings call. I hope you like this format. After this, we'll talk about the intrinsic value of FICO. What is the good stock price? Whether you want to buy or sell or hold. We'll play around with the DCF on Stock Unlock and find an intrinsic value for the bullish scenario, best case scenario, base case, bull case, bear case. Okay.
The guidance, I understand, you're still being, seems like being conservative on your assumptions regarding volume. Just wondering if there had been any sort of change to your volume assumptions after the last quarter at all.
Not really. I mean, again, we tend to be pretty conservative because obviously, there's a lot happening in the world, and we get that number wrong. It's difficult to make it up someplace else, but not really. I think we had a better second quarter volume-wise than we had anticipated when we gave guidance. But we don't necessarily think that's going to continue, so we tend to take the same conservative approach for the rest of the year.
Got it. And then just on the buyback, I mean, the number, $600 million in the quarter was great to see, along with the incremental buyback this quarter. Just wondering, I mean, how aggressive do you think, or would you guys be, with the stock at these current levels, and given the capacity that you have?
That's a good question, but it could have been even better if he had talked about this. What I showed you before, guys. To some extent, you guys are better analysts than some professionals. Congratulations. It means the retail investors can be sometimes better than the professional crowd. I mean, since we have the granularity, exactly the level of buybacks they did for each month, and now it seems like they are slowing down. Why? Any reasons why? You have a blackout period, but how do you feel now that the stock is $1,000? Do you want to buy more? Do you want to be aggressive? Do you find an intrinsic value inside? What is your model to value the business? That would have been a good question. Why are you slowing down? Do you find that $1,200 is the bottom? Is a threshold? How do you see the situation?
What I can say is what we've said in the past. We're always interested in share repurchase, and we're in the market kind of all the time. And we tend not to be market timers, although we have leaned in much more heavily on an opportunistic basis. I would certainly consider our stock at these levels to be, an opportunistic time.
Next question.
Your line is open. Please go ahead.
Great. Thanks so much. I wonder if you had any thoughts on, given the current shifts in the regulatory environment, do you feel like that's pretty much contained at this point, or is there anything else you're kind of focused on as we think about, whether it's FHFA or other parts that you kind of continue to manage through from a regulatory perspective?
The mortgage market is a $13 trillion market, and everyone takes it pretty seriously, and no one wants to do things that are reckless there. And so everything that happens in that market, you see coming a mile away. And I think that's kind of where we are. I think we know everything there is to know about the way this is unfolding for now. And so that, no, I don't really see, being blindsided by regulatory or other kinds of things in the market. I think we understand how the market's evolving. We understand what the choices are for evaluating credit in the mortgage market. Will things change if the GSEs get out? I mean, that's anybody's guess when and if that happens. And will things change? We actually don't think they'll change that much. We think that in a world where the GSEs are private, or if they were to lose the guarantee, the emphasis on credit default risk would go up. The interest in credit default risk goes up, and that's advantage FICO because we have the best score for evaluating that. But again, these are more theoretical and down the road kinds of things. I don't think there's any surprises ahead.
Yep.
So, thank you.
Please go ahead.
Great, thanks. Most of my questions have been taken, but just maybe, Will, I guess any stats or detail you could provide in terms of the uptake of 10T within the non-conforming market at this point, mortgages?
Yeah, I don't have that. I don't have an updated number for you, but we have underwritten trillions.
Yeah, most of them are running it in parallel with plastic because they want to be able to use the latest score, and so they run them in parallel with each other.
Got it. I guess any running.
I think the number is 1.2 trillion. The latest number.
Okay. Thanks very much. Appreciate it.
Thank you. And please go ahead.
Hi, good evening. Thanks for taking my questions. So with VantageScore, I was wondering if you could discuss a bit more about potential adverse selection, how lenders could pull both scores in the beginning of a process, but could pick one or the other for the remaining initial result. and the implications there for the mortgage market?
Great question.
Yeah, it's a good question. I think, and of course, we don't know how this is going to unfold. I mean, it is strong. It's really in the interest of the GSEs and the FHFA to prevent gaming, to not have a gaming situation. That said, in a two-score system, it's almost inevitable. It's kind of structural that one score or the other is going to be more beneficial to the consumer at all times. And so, in a world where the systems are in place to use both scores and barring other unforeseen things, there will be some people who pull both scores. And so it may unfold that way. I think to the extent that happens, that's not, I mean, it is technically share loss for FICO, but it's not volume loss. What you're really doing is expanding the market by the second pull. And so, it's conceivable the Vantage could get some share that way if they don't solve the gaming problem. But I don't see volume loss for FICO.
Yeah, maybe the government can force people to use VantageScore for free, so it will double the amount of credit pools, but no meaningful share loss for FICO. Yeah, it can happen.
Great, thanks. And then I was also wondering, just with the auto and card P-loan growth, if you saw any volume weakness later in the quarter on account of the macro, and if you were seeing any
the auto
consumer weakness there.
Yeah, I mean, auto tends to be pretty stable. Unless there's like a really disruption in the economy. A lot of the volume on the card side is really the banks that are marketing, and if they want to market more, they'll find consumers that will take it up. So and that can vary quarter to quarter. But so far we haven't really seen any significant weakness on the volumes. They've actually been pretty good. There's been a little bit of a fall off of the subprime, but it's been picked up throughout the rest. The prime, super prime. So we haven't really seen anything.
Got it. Appreciate the color. Congrats on the quarter.
Thank you. This does conclude today's question and answer session. Ladies and gentlemen, this also does conclude today's conference call. Thank you for participating, and you may now disconnect. Everyone, have a great day.
Thank you.
No closing remarks. What a call. What a call. Wow. So, let me do a quick recap of what we learned. The market share of VantageScore is 2%. There are some changes. The government is pushing for more competition. FICO is complying. FICO has increased their prices, but now lowering their prices with the new pricing model. So they increase their guidance. VantageScore with the Equifax, the credit bureaus, TransUnion, they talk too much. It's only the starting point, and nobody knows anything. Nobody knows if the market share will change or not. When it comes to AI, no major disruption risk because it's something that is very regulated and FICO acts as a stamp of approval. So you don't play around with these kind of things. You don't play around with these kind of sums. As long as AI remains a black box and the algorithm is changing all the way, it reduces the visibility for the entire industry. And of course, the US doesn't want that. So you want a model that works. You want a model that is sustainable, predictable, that you can trust. And FICO has been here for decades. So they can play around and do whatever they want. They think they will win. And they think nothing has changed when it comes to the regulatory environment. I mean, they think they can continue to raise prices, to have more volume, and to continue to win. And they just did their biggest buyback ever. So they think they are cheap. The last time this situation happened was in 2021, in late 2021, beginning of 2022. And after this, the stock went on an immense run. The stock went from 400 to 2000. Let's see how it goes. In 2021, it did nothing for 1 year. It bottomed and then rebounded and bottomed again. Two bottoms, like for 1 year you have nothing, and then it went up. It was included in the some indices. So maybe it can bottom, rebound, bottom again, wait 1 year and then go up. Anything can happen at the moment. Now, I'm done with Fiscal AI. If you want to use it, you can click the link in the description to try it out completely for free. I want to show you the intrinsic value of FICO. If we use a DCF model, a discounted cash flow model, the best DCF model is on Stock Unlock. Similarly, is the best one. You have a link in your description to get a discount. It will be 10% cheaper if you go through my links. I'm using this on a daily basis. This is the best DCF model, and I've been using this for years. Okay, so I highly encourage you to try it out. If you think the free cash flow will continue to grow at 14-15% per year, and you think this is a business that deserves a premium valuation, like a price to free cash flow of 30, if you think they will have a discount rate of 10%, this is what we put, 10% as always, and they will continue to do buybacks at 4% per year, they are doing this right now, then if these are your assumptions, then FICO is 36% undervalued today. The fair value is $1,300. And if you buy right now, today, you can expect to have a CAGR, a compound annual growth rate of 17% per year. This would be my base case scenario. I think this is the fair value for FICO. This is what I think. Now, what if you are bearish? What if you think Vantage Call will disrupt them, slow them down, and take meaningful market share? Well, maybe the free cash flow will not grow at 15% per year, but it will grow with volume. 5, 10, let's put 10%. If they lose their moat, the price to free cash flow can go to 20, 25. I mean, it will be a duopoly, so let's be conservative. Let's say price to free cash flow of 20. They continue to do buybacks at 4% per year. If these are your conservative estimates, then FICO is 27% overvalued, too expensive. The fair value is $730. And if you buy right now, you can expect a CAGR, a compound annual growth rate of 3% per year. So not great, not good, okay? For conservative people, bearish people, this is what they think. Maybe they think the free cash flow will grow at 8% per year, it's even worse, 5% per year, it's even worse. What about the bullish scenario? What if you think FICO can grow free cash flow at 20% per year? On an average basis, right? It will go up a lot and then stabilizing, but price increases. I mean, they have grown free cash flow earnings 60% this quarter. So anything can happen. Let's say we are being optimistic on a bullish scenario. If free cash flows grow 20% per year for the next 5 years, the moat remains 30. And because they grow so much, I think the stock price will go high. Let's say they reduce buybacks to 2% on our bullish scenario. Then FICO is 50% undervalued. The fair value is $1,500. And if you buy right now, you can expect to make a CAGR of 19% per year, of 20% per year. And yeah, that's pretty much it. The bear case scenario, the base case scenario, and the bull case scenario. You have the 3 scenarios that can happen depending if you like the idea, if you want, if you are aggressive in your growth rate or not. Okay, so this was the only video you need to watch to understand everything about this earnings report. I hope you liked this format. Don't hesitate to leave a like, comment, subscribe, become a member to this YouTube channel to have access to live sessions, because we'll talk about this. We'll do more analysis like this. I hope you like this format, and I see you tomorrow. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn my strategy to generate 25% annual returns. You will learn how to find winning opportunities. You will learn how to properly value any stock, when to buy, when to sell, so that you can build a strong portfolio filled with great companies. Additionally, inside this coaching program, you will have access to an exclusive community of like-minded investors, and also you will have my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need for your email address, just click the link in the description and I'll see you on the other side.